Hey guys, welcome back to Chart of the Week with Glassnode, where we break down some of the most important charts in crypto. So today we're taking a closer look at implied volatility in Bitcoin options. So here in dashboard, you have a dedicated one focused on implied vol for options. But now I'm going to zoom in an option metric, which is the option at the money implied volatility. So quick reminder, implied volatility reflects how much movement the options market expects over a given time horizon. Higher implied vol means traders are paying more for protection or for convexity, which is upside exposure, and lower implied vol means uncertainty is being priced more calmly. So now looking at the charts, over the last year, at the money implied volatility across maturities has generally trended lower. Short-dated implied volatility shows occasional spikes, but those moves fade quickly. Longer-dated implied volatility, on the other hand, remains stable and relatively shallow. We saw this clearly as Bitcoin rallied into the mid and high 90s. On the first attempt, near-dated vol was bid and quickly sold off. But on the second attempt, we clearly see that even the 1 week maturity was not even bid, it was quickly sold off by gamma seller wanted to monetize that move by selling higher premium. So this is showing you an example of how you can gauge the sentiment of the market using the at the money implied volatility. This move was clearly lacking confidence and backing by the options market. So overall, this is a volatility regime defined by compression rather than expansion. Spot moves still trigger responses, but they stay contained inside a broader subdued envelope. The term structure, zoom in on the 2 weeks. The term structure is quite compressed as there are only 3 vol points between the 1 week and the 6 months. Participants are not forced hedger and they are not chasing momentum. So it does not mean that volatility is cheap or being ignored. It does not mean risk is gone, and it does not imply a directional view. It simply means the market is absorbing uncertainty over time instead of compressing into the near term. This is what we call volatility being warehoused. A market warehousing volatility is saying we know something could happen, but we are willing to carry that risk. Volatility is not extinguished, is being stored over time. A market that is panicking tries to get risk of the book right now with a very high vol in the 1 week maturity. So such regime that what we're seeing right now is self-reinforcing until they are not. That's why one should remain cautious selling a lot of gamma at those levels. So thank you for watching Chart of the Week. If you enjoyed this video, give it a like and we will see you next week.